Hi, everybody. Welcome to the Middle Class Investor. This is Seth Martin. It is Friday, October 28th, and you can see here we've had another down week. Um, Last week was slightly up. We've had down, down, slightly up, and then down again. So in the last, I don't know, several weeks, we've been kind of trading in a range. Well, let's just put the whole range on here from here to here. But the bias, about half of it has been down here in this, and kind of edging down. So it's hard to say what the market. To me, it just looks like the market's waiting for something. I don't know if it's earnings related or if it's election related. Um, I don't. I mean, there could be some, very short-term action as a result of the election. I don't think the market really follows elections uh, very closely. So I don't think it really matters, at least from the market standpoint, which candidate wins the election. But it does appear like this market's waiting for something. Maybe it's waiting on the Fed. Who knows? But what's interesting is for the last 1, 2, 3, 4, 5, 6, 7, really 8 weeks, this moving average here has really been keeping a lid on the market. And let me pull out here and let's see what moving average that is. That's the 10-week moving average. So that's the same thing as the 50-day moving average. So if we were to look at a daily chart, I don't have a 50-day moving average here, but it would be the same as a 50-day moving average. Like the 50-day moving average is now declining. We really haven't seen a declining 50-day moving average since right here. So that's not insignificant. The 50-day moving average started to decline right in this area. You can see this where the line was turning down here, and it really hasn't turned down since then. And that was back in, well, that's back in the beginning of December. So since about mid-August, well, not even really then. I'd say really maybe like right here since the 1st of October, the 50-day moving average or the 10-week moving average has been rolling over and declining downward, as you can see right here. So about starting about right there to right there, it's declining. And anyway, it may continue to decline. It may come down here and meet this moving average, where this moving average is kind of curling up and this one is curling down, and then they diverge, or they converge rather, and then maybe the 50 starts to pull up again. Not really sure. Like I said, it just appears that the market is waiting for the Fed, waiting for elections, waiting for something. Now, with regards to the Fed is not going to do anything here in November. We've talked about this chart before. This is the 13-week. Let me do this first. There we go. This is the 13-week Treasury, and what I said basically is the Fed is going to keep interest rates the same until we get up here, not only trade above here like it traded above here, but start closing above here and staying. And then you'll see the Fed, I think, raise rates. Again, the Fed doesn't set rates; it follows the rates. The market sets rates. It's not well known. In fact, it's a misnomer that the Fed sets rates. So I still haven't put that video up. I need to do that. I will do that. Just haven't gotten around to it. Let's look at the VIX. It looked like to me that we were going to get an expansion in volatility, and we just really haven't gotten it yet. There's been some expansion in volatility, but certainly not anything like what I was expecting. I mean, I was really more expecting volatility to kind of start breaking out up into here, maybe even here. but obviously that hasn't happened yet. So a couple weeks ago we had a little spike up, but then it pulled back, and then it gapped up and then pulled back even further, and then this week it gapped down and then ran up. So volatility is all over the place. There is some divergence between sentiment and volatility, and that could mean both an expansion in volatility and then a rollover or decline in the market. So we'll keep a close eye on that. That may coincide with some event that the market appears to be waiting on. Let's look at the euro US dollar. I think this pattern is complete, as you know, to an untrained eye it doesn't appear complete, but this little, normally what you would get, this looks about right. The way the market went up here, went down a little bit, retested the line, and then rolled over. So what I'm expecting is maybe the euro to get up into this area and then decline out of this formation over the next, I don't know, 4, 5, 6, 8 weeks, something like that. You can see here in the RSI we got a little curl up, so we could see a week or two. Maybe next week we get a, you know, like a doji or something in here, something that where it's like this on either side, and then maybe then the next week we get a candle like this, and then another candle like this, maybe with a doji like that, and then maybe start declining again. So you know, maybe 1, 2, 3, you know, maybe 4 weeks the euro start declining, 3 or 4 weeks. So keep an eye out for the euro. And of course, if the euro US dollar is declining, that means the US dollar is going up against the euro. So, and I think that kind of coincides. We'll go to the dollar in a second, but let's look at some of these countries first. Let's look at Germany. Germany continues to be bound by this channel. In fact, to draw the channel, probably this isn't accurate. We probably need to, well, I'm not going to be able to do that. I'd have to just redraw it. So here I'll redraw it real quick. But the proper way to draw the channel is probably to include all this price information. Whoops, what happened? Came back. Delete. Okay. Let's go back to here. And then let's see, we had it about right here. Like I said, the channel tends to, it appears to be, you know, capturing the price action. So I would expect Germany to continue to start declining. It's interesting here when you zoom in. Look at how this this price action has held. I mean, right through here in a tighter channel. I mean, it's just walking the line. I think that's very interesting. Eventually, what'll happen is it'll break out and you'll get a big candle like so. So and then it could retest. So a lot of times it'll retest the bottom side of the channel and then start going down again. So but anyway, I think Germany does seem to be bound by this this downtrend here. So we would expect that to continue unless it breaks out above. Now this is Japan, and it appears to have broken out of its channel, and so we might expect maybe a retest in here somewhere. So what I mean by that, I'm not trying to use terminology that you maybe don't understand, but what I've talked about this before, where we kind of break out and then we get a little corrective move back to the channel line, and then a resumption of the trend. So we might see something like that over the next 8-10 weeks, something along those lines. It could be shorter, but maybe it's already happened. Maybe this is all the pullback we're going to get too, and it's just going to start taking off. But a lot of times it likes to retest this channel line and then start moving up. So That's what I would expect to happen, but it could be that it's already pulled back all it's going to pull back. Let's take a look at the United Kingdom. Again, we don't have a channel drawn here, so maybe I should have drawn one. A lot of times I just used a downtrend line. I usually don't draw a channel unless I'm trading just thinking here where to draw this. Maybe like that. So we had this breakout, retest, and this may be ready to move out here for all I know. We could see the UK start to climb higher at this point, maybe up into this area around 1750 before declining again. So usually in a move like this, so the whole move is from, let's say, here to here, assuming that it's over. You want to look for like a 62% retracement of the trend. So if this is 100%, then a move back to here would be 62%. That's very common. You see that a lot in trends. In fact, if I see one, maybe I'll measure it and show it to you and let you guys verify, what I just said. So, the Russell, it looks, the Russell and the NASDAQ to me look the weakest of the indexes here in the U.S. But this kind of looks like a standard pullback. I mean, if you were to draw a channel around this, I mean, it doesn't mean it can't go lower here, but this is kind of right at the channel. And so, we might expect the Russell to start bouncing here, maybe make a new high, maybe only a slight new high. So we'll just see. There's still the RSI still declining, so it may take a little longer. Of course, this is a weekly chart, and from a 401k and a long-term investor standpoint, that's the time frame we're really interested in. Is when to be out of your 401k and on the sidelines. You really don't want to make that decision more than a couple of times a year. So, all right, that's about it for those. Let's go over and look at the dollar and gold. You can see that here's that decline starting in 2000 in the dollar. And just for grins and giggles, let's see what the retracement point is, assuming this is the direction of the primary trend. And when I mean primary trend, again, I'm talking about the trend in the very large long-term direction. Okay, so see how we're right here at the 61.8, which is basically 62%. So this zone here between here. Let me zoom in a little bit. So I'm sitting here talking about this, and so this is the 78.6 line right here. And this is the 61.2% line here. So somewhere in here is a very logical place for the dollar to reverse and start going the other way. Those numbers, 61.8, and those are Fibonacci relationships. They're ratios. And 61.8 is the golden ratio. It's an irrational number that it's an irrational number that is in the Fibonacci sequence. Let me start with that. It goes 1, 1, 2, 3, 5. So what you do is you add the current number to the previous number and you get the next number. And it turns out that as you go out to infinity, and you divide the small number by the bigger number out at infinity, it approaches 61.8%, which is known as phi. Phi is I don't know why they call it phi. It's just a symbol that represents, it looks like this, with a circle with a line through it. And phi is just a unique number. For example, we actually did this, me and my son. if you measure your total height and then you measure the height from your feet from the floor to your belly button, you'll find that from the floor to your belly button is about 62% of your overall height. If you look at the way your fingers are segmented, you have your outer knuckle and then your next knuckle, and what you'll find is that those are about 62% of each other. Our body segments in this phi relationship. Branching, if you look at branching, the number of branches at each greater segment is represented by a Fibonacci type of sequence. So somehow it's a ratio, it's a number that's embedded in all of us. I don't know how, but it comes up in a lot of areas. So all that just to say that we use it as a ruler to see, okay, if we've got a swing in a particular direction, what is the counter trend swing? Where are we on that counter trend swing? So I like to use these pivots because the numbers, it never goes right to 62%. That would be too easy. But it does go, really close. Sometimes it goes right to it, and sometimes it doesn't. But so what we're expecting to see here is we're expecting to see the dollar to move all the way up into this 105 area and maybe even slightly higher. So, and that's going to take several months still, and it'll coincide with, the euro sliding to the lows and British pound going down and stuff like that. So let's look at gold. Gold also, if the dollar is going to increase, you should see gold decrease. Now, there's not a direct correlation. It's not a 100% correlation, but it's a pretty good correlation. So, sorry about that. Jumping around a little here with that zoomer. So you might see gold maybe go slightly higher here and then down into this area, or it might not. It might only go down. Let's say it goes up a little higher and then makes a slightly lower low, and then comes up and makes a high above this pivot right here. So there's a pivot right here, right? So we would look at a zone just above that pivot right there, let's say. So I know that's crazy that I'm saying, well, gold could either go to here and then up to here, or it could go down all the way to here and then up to here. I think it's going to make a higher high, though, before it goes substantially lower, and I've shared with you where I think that's likely to go very long term. And when I say very long term, this could be several years from now. But I'm expecting gold to ultimately get down to this area just below $700 off of this pivot here, this very long-term important pivot is right here. There's a pivot that, whoops. Let's see if I can, why can't I get that to right? Let's try that again. Sorry about the technical difficulty. So right, whoops, that's a box. Didn't mean to do a box, meant to do a line. So you can see there's a good sized pivot there, and that pivot corresponds to my box over here. All I've done is drawn a box just below that pivot, and I'm expecting the price action to come down in here, which also coincides with this pivot in the opposite direction. So these two pivots, if you connect the pivots, they almost intersect with one another. You can see how they almost intersect with one another. So this is an area that I think is very important in the gold market, and one that we're likely to see before gold really starts making a new leg up. So, and right now it's still just in its, this is the first leg down, then we've got a counter trend move, and then we got a third leg down, and then we should see a huge move in gold. Silver and gold track each other pretty closely. There's slight differences. You can see this pivot over here really matches up well with this one here. This pivot here. Here, let me zoom in again. So when I connect these two, when I connect this one to this one, they actually do intersect. You can see right there. So is a very likely zone to see silver at very long term, and I mean like maybe 3 years from now, two to 3 years from now. So we're talking below, around $8 to $7.50, something like that. All right. All right, let's look at oil. Oil, all important commodity. You can see here the very long-term target I've got in oil is down here around 16 and a quarter. So that's an area. Now it might not go that low. It might only go to just a low below this pivot. So we could very well only see oil in this area right here. Let me draw it. Maybe a pivot off of this area. Maybe the low's already in, but I don't think so. I think I've shared with this before. I think we're at least going to go down to here, this $20 area. So let me zoom in on oil so we can kind of see the move. And we've had this box drawn on here for some time now. And I talked about how, same thing I did with gold, I talked about how it could go to that pivot. In fact, I drew this red line because I wasn't even sure if it could make it to the yellow. It made it to the yellow. And then I talked about it pulling back, which it almost did to our box, and then making another run up into this area. It could very well be done, or it might make just a slight higher high than it is, and then start to run down to this box, and then up, and then maybe a little lower. So silver and gold pretty much track one another fairly carefully, or fairly closely rather. Let's look at the Great British Pound and the US dollar. It's, the pound has just been a train wreck. What's happening there? Of course, they're blaming it on Brexit, but that's really not, that's not the cause directly. The cause directly is that the UK has been running a trade deficit with the rest of, with the world and with Europe. And now that they'll have to, that they'll only have their own currency, they won't have the euro to lean on. They'll actually have to convert, if they have a trade deficit with, say, Germany, okay, they'll actually have to convert pounds to euros and pay Germany in euros. And so what they're saying, what this currency devaluation is showing you, is that the outflows, there's not really truly outflows. There's just currency equalization, if you will. But what's happening is the British pound is losing value because everybody knows that they're trading, that the way they're going to have to trade is very different. They're not inside the euro anymore, so they can't split the cost of their trade deficit with everybody in the euro. They'll have to bear that burden all by themselves. And so what the market is telling you is that burden's pretty significant, and to offset that burden, the British pound has to go down in value. So, but that's trade. That doesn't have anything to do with the way Great Britain's going to be governed, or doesn't have anything to do with the improved freedom they're going to have, or anything like that. This is simply a trade deficit phenomenon, and this is the way that it gets rebalanced. Okay, so don't be confused in the media when they say, "Oh, Brexit's destroying the pound" and all this other stuff. Yes, it is, but that's only because Great Britain doesn't have enough production. They need to produce more goods and services to offset their trade deficit. If they didn't have a trade deficit, you wouldn't see the British pound falling like this. If they were more at parity with the countries they trade with, the British pound would either be going up in value or be trading sideways. It wouldn't be falling like a rock. So So anyway, I hope that helps you understand a little bit about what's going on there. Um, the Swiss franc, it looks, it had this long down move. Now it looks kind of counter trend. It looks like maybe it could go a little higher, maybe even up to here. So I don't know if these currencies are important to you, but I thought I would just share, uh, kind of what I was seeing on them. The U.S. dollar JPY. Now, what's going on here is Japan is just destroying their currency. I mean, they're just, uh, you know, let's say that there's 100 of us, okay, and we each have 100 yen in our pocket, okay, and the Japanese government decides to print, 1,000 yen. Well, what happens is, in terms of goods, in terms of purchasing power, the yen that we already have in our pocket is devalued. It loses value because now there's more yen out there, but the number of goods and services that you can buy with the existing yen hasn't increased. So what happens is the currency has to lose value, and that's exactly what's happening here. They're printing. They're basically printing money or digital money or creating money. That's maybe a better way to say it. And at their central bank, at the Bank of Japan, and they're buying Japanese debt. So they're buying Japanese debt from themselves. And this purchase of debt from themselves in the quote unquote open market, which is not really a market, creates additional money. And that's what you see here with the Japanese yen. So I'm expecting the yen to go a little higher, maybe up into this box before it rolls over and actually makes a lower low. So, and it could be significantly lower, below 100 here. So keep an eye on that. I've actually changed my accounts where I can trade forex. There's a lot of interesting things happening in the forex market. These markets are moving pretty rapidly. A lot of money to be made. Basically, the forex market. The things you need to know about the forex market is it's unregulated. So that means you're not really trading with other traders in the market. You're tied to some financial entity, a bank, or your broker is got, let's say, 1,000 clients, and they're trading forex with other banks and other entities. So in other words, there's some visibility of your position and the price you own your position at. And the worst thing that happens in the forex market is if you put in a stop. So let's say that I'm trading this. Let me zoom in here and I'll show you what I'm talking about. I'm just going to give you an example. Let's say that I entered a trade right here on the yen to go up, okay? And my target is up here, okay? So this is this space right here represents my reward, and my risk is represented by, let's say, a break of this pivot low right here. So you can see this pivot here. So if I break this, then I'm out. So my risk is here. So risk is little r, and reward is big R, okay? Risk reward. So this right here would be a stop. So in trading, golly, that's a horrible stop. Let me try that again. I'm trying to make an S. Okay, S, stop. So when you put your stop in, let's say you enter the trade, you're in the trade right here, and then you go back, you open the platform, and you enter a stop right here. What happens is the people that are tied to your brokerage, they can see your stop. So if they have an opportunity to trade with somebody else in the world at some value and they have to take your stop out in order to do it, that can happen, and there's no regulation, there's no Congress. Let's say it traded back down into here and your stop's here. You might see a candle that looks like this where they drove the market down, hit your stop, stopped you out, and then the market proceeded to run to your target like so. okay, like that. So that's the thing you got to watch out in Forex, is how you do your stops and how you protect yourself on the risk side, because uh, these crooked people can come in there and take out your stop and then turn the market and start running the other direction. That cannot happen on the New York Stock Exchange, the NASDAQ, the Chicago Mercantile Exchange. Those exchanges are all regulated such that nobody has visibility to your stops or your position until it gets within a certain distance of it. So let's say you had a stop at 100. Well, your order won't even show up to the market maker until you're like within a quarter point of 100 or half a point, something like that. So there's not a risk of somebody running a bunch of stops and then turning and flipping the market back the other way. I hope that's not too confusing. I just wanted to mention that there's a lot of opportunity in Forex, but I wanted to caution you too that Forex is just not a regulated market. Now, you know, other than that, it's a pretty cool market. It's highly leveraged, and you hardly need any money to trade it. You can start a Forex account with a couple of $100 through FXCM or Forex.com. So anyway, just thought I'd mention that. There's going to be a lot of interesting things happening in currencies as flows start to adjust to Brexit and other types of problems that are going to start cropping up in the economy. All right, that is about it, I think, for this week. I don't think I have anything else to share. If you have any questions, certainly ask the questions in the YouTube comment section, and I will get to those. One of the things I did mention last week, and I went to a daily chart to mention this. Let me look at it daily real quick. Is I was mentioning that all this price action was happening below this line, and you can see we're still there, right? I mean, all this movement here over the last many weeks now is all happening below that line, and then today we broke even further. So we could, I mean, who knows? This could, you could get a big sell-off, one of these 15% sell-offs out of this. I don't know for sure. I've talked about how the reward, the upside, is pretty insignificant compared to the downside risk. Now, as the market's pulled back further, that's less and less true. I don't think the market's going to pull back any further than an area around this line right here, which is at 2110. But if you see the market, the S&P 500 pull back through 2110, it's likely going all the way down here to 1950-ish. So keep that in mind. It doesn't mean that's going to be the end of it. It could go up and make one more run up, but that's, like I said, that's a significant move. Let's see, from the top, right in here is when I started talking about really, at this zone up here, hey, you really ought to maybe think about just taking some money off the table. So from here all the way down to here, that is, it's only 9.3%. That's only a 9.3% move, so that's not too bad. But it could be bigger than that. I mean, that may just be the start. So anyway, just wanted to point that out. All this price action is happening below this little support line here. So technically, support has been broken, at least trend line support. Vertical support is a zone around this number of 2110. So if we start trading below that, then I think we're going even lower, like I said, down to that 1945, 1950 area. All right, everybody. Thanks for coming in. Appreciate it. Look forward to seeing you next time. And like I said, if you have any questions, put them in the comment section of YouTube. You can also follow me at InvestorClass. Middle Class Investor is @InvestorClass on Twitter. And of course, if you ask questions there, I'll be happy to answer them as well. All right, everybody, take care and have a good evening. Bye-bye.